Welcome to Financial Strategies with Andrew Adjemi in Connecticut and Daniel Adjemi in Colorado.
Not too long ago, I was speaking with my cousin who's a businessman, and he was talking about how he couldn't believe it that, if his dad were alive, who was also a businessman, and told his dad that he was buying stock, or people were buying stock at what people are buying stock at today, at the valuations and how people are buying stock today in the stock market. His father just couldn't imagine that. If that were to, how that could possibly be based upon how he is used to doing it in back in the day, as we say. I'm Andrew Adjemi.
And I'm Daniel Adjemi, and you're listening to Financial Strategies. Today, we're talking about dumb money, and we're not talking about the movie Dumb Money. What we're talking about is probably the dumbest algorithm that ever existed. And it's something a lot of people are involved with, and it's something that a lot of people don't know about. So if you are open-minded, if you are open to learning new things, then this show is just right for you. AAA,
That's right.
There was a time when people looked at an investment as a cash flow on a business that they wanted to own, correct? Right. And that's what these businessmen you're talking about were used to. They owned a business, and they didn't buy the business because they thought more people would buy into the business and drive the price of the business up.
Right.
They bought the business because they saw it would generate a cash flow that would be profitable to them. And then they could do whatever they wanted with the cash flow. They could reinvest it into the business. They could invest it into other businesses. They could spend it. They could do what they wanted. Correct?
Right. Correct. Right. And, a practical way of describing that to our listening audience would be, think about, you retire, say, hey, wouldn't it be cool to get an ice cream parlor, for retirement, and we could have all the ice cream we wanted, and we could maybe make some money at the same time. So you go to the nearest ice cream parlor and they say, yeah, we want $1 million for this business. And you say, $1 million, huh? How much money do you bring in here? And they say, oh, $50,000 a year. And you say, you just run out of that place because that doesn't make sense, right? It's going to take you, 20 years, to make back your
Andrew,
money.
You'll be able to sell it for $2 million in 2 years.
Well, then that's what it is today, right? And that's what it is today, right? Where it should be, right? Where that that business should be going for $500,000, because in 10 years you can pay back the $500,000, and then anything after that is gravy and profit from that standpoint. So it's a huge difference between what's going on today, because people are saying, and that's what's happening. Daniel, I like cars, right? I went to the Meekum car auction in January down in Florida, and these cars are going for these crazy prices. And, even when I'm watching them on eBay or online at some of the auction sites and some of these things that with what they're going for, and I'm convinced that people think, well, but they're going to go up in price. Well, and that may happen, but will it happen? And will it happen in the short term, or will it happen in the long term, right? Who's got a crystal ball for when that's going to be? But that's kind of what we're talking about, is that, the idea of dumb money, right? Is that people have so much money that they're buying stuff. And when it comes to the stock market, you put money into the 401k plan or your retirement plan, and the algorithm says, okay, I got this money, I got to buy stuff. And they just buy stuff. It doesn't mean that it's good. It's just buying to buy, and, hoping that it's going to be worth more at some point in the future. That's what we're talking about. But that's a dumb, stupid way to invest. But that's what these algorithms do, because there's so much money going into the market from positive cash flow into the market.
Well, it's also maybe a little bit more cynical than that, right? Because you have these good institutions that are trying to do what's in the best interest of mom and pop, right? You got these wonderful charity-minded organizations like Vanguard and BlackRock, right?
Yeah, charity-minded. Yeah.
And that's where this big lie comes in, this big falsehood. You could call it the biggest con to modern investors, right? Where Vanguard or BlackRock, they say passive investing is the way to go. You're going to buy this index, you're going to buy this indice, and you own the whole market. But what ends up happening is they're not constructed in a way where you own the whole market, or they're not really passive, because the way passive is defined is that you buy something and you hold it. There's no trading going on. Well,
Right.
these passive flows, right? These passive funds, number one, they're trading stocks or bonds, depending if it's an index of bonds or index of stocks. And bond funds are even worse. Bond indexes are even worse. And we'll get into that. But what's going on is there's someone trying to track an index, and their job is not to look at if this is a good investment.
Mm-hmm.
It's not to see if this is a good value. It's not to say things are expensive today, so let's hold more cash and wait for better entry points.
Right.
All their job is, the fund manager, I just read an article about this, one of the Vanguard fund managers managing $1 trillion in a bond fund. Do you know what the job is? It's not to see if these companies or governments are credit worthy. It's not to see if it's a good deal. It's just to make sure that the tracking of the index is proper.
Just make sure that the tracking is proper. That is, oh man, that certainly is a far cry from the way things have been done in the past, in old school, right? You listen to Financial Strategies with Andrew, Daniel, Ajmi, because people don't know what people don't know. Today's topic is dumb money. And we have a paper that goes along with today's show that will help educate you and help you understand what we're talking about. It's called Understanding Price to Earning Ratios, PE ratios. And that's what I was talking about when I was talking about that ice cream parlor and what to buy it, where the value is the price of the ice cream parlor versus the earnings of the ice cream parlor. And this paper will help you be able to understand that a little bit more clearly, be able to help you understand the way that things should be when it comes to investing. And you can have it for free by calling us at 800-725-7616, 800-725-7616. Call them out. Daniel, there's that saying, right? It ain't what you don't know that gets you into trouble. It's what you know for sure that ain't so. And these things that are going on are, a lot of people don't know what's going on. That's why we're having this show, right? To educate them on what's going on so that they can put their portfolios, have a better, thoughtful, active, robust portfolio for themselves, protect them against these things. But, I don't know if people still yet have the idea of what's actually going on with these, passive investing being aligned to money. What's some other ways that we can describe it?
Well, the thought, Vanguard and Jack Bogle were kind of the pioneers, the inventors of this kind of passive. You just buy the market, right?
Yeah. Right.
You buy all stocks. And so I
Right.
think there's something like 4,000 stocks in the market. So you buy those 4,000 stocks, and that would be more of a passive investment if you owned all those. But the difficulty is it's not passive because new money's coming in. So they have to buy and they have to sell when monies go out. So it's a lie. The passive is a lie. But then what ends up happening is we own a bond index, for example, and the bond index doesn't own all bonds. So therefore it cannot be that passive strategy as it's advertised to be. The other thing is a lot of these indexes are market cap weighted. And so that means more money is going into fewer stocks. So for example, one of the biggest indexes that most people own would be the S&P 500.
Right.
And so you would say, well, that's pretty diversified, right? 500 stocks. The difficulty comes in when they're market cap weighted and a stock like Nvidia just goes to the sky. It's got this huge market cap. That means when money comes out of your 401k, out of your paycheck, and it goes into that index, more of your dollars, so say it's $100 coming out of your paycheck, a larger and larger percent of that $100 is going to Nvidia. Did Nvidia become a better deal because it went up in value? But no one's doing that work and saying, okay, typically what happens is even if this is a great company, it gets overhyped and then it comes back down. And And they're doing that research to say, and we think it will be worth more in the future, but let's wait till some of this hype comes down. There's no one doing that. And that's where the dumb money comes in. It's this algorithm that says, I have money, therefore I must buy. It doesn't matter what the price is. It doesn't matter if I'm paying 100 times earnings for this company. It doesn't matter if it's only going up because flows are coming into the company. I have money and therefore I need to buy.
Yeah.
And then what ends up happening is this 500 stock index turns into 30% of it being 7 stocks or 6 stocks, right? And so you're not diversified into 500 stocks anymore. And then when we go down into industries, it's even worse. Because it's the tech part is this enormous section. And then things that used to be like materials or mining or industrial is such a small fraction of the index. And so when people are saying you're passive and you're buying the market, you're not. What you're buying is a sort of social investing where everyone's money is going into one pot. Everyone's money is going into 7 stocks. And you don't need to be an investor. You don't need to spend every day looking at investments to understand if a percentage of everyone's money, right? Everyone's paycheck is going into 7 stocks, how that can end. That doesn't mean it's going to happen tomorrow, but we all know that what goes up, right, must come down.
Right.
If everyone's money's funneling, a portion of everyone's money's funneling into 7 stocks, that's not going to end well for some people.
Mm-hmm.
Right? We can look through history. That doesn't mean that there's not good investments because we see a lot of good investment opportunities. But what we're saying is this massive lie that's going on of these institutions, especially like Vanguard and BlackRock, who say that their job is just to facilitate a way people can invest. What really they are is a marketing arm. They're marketing that this is the best way to invest, and they're gathering huge amounts of money, ungodly amounts of money that they're charging a small fee on. But it's not good for the investor. Who it's good for is BlackRock and Vanguard. And we'll get into a little bit more of what's going on in more depth in the next section. But it's crazy how big of a behemoth this has become over the past, decade especially.
Right. And people, three things that are certain in life are death, taxes, and change. And, change is always going to happen, whether it's for the better, for the worse, but you don't know when, you don't know how. And that's the point here. You can't keep investing the way that you've always invested, especially if you're in or close to retirement. You should be changing the way you invest anyway as you head into retirement. But with what's going on out there with this dumb money and these passive flows, it's even more so. So I agree with you 100%, Daniel, and looking forward to getting into that more. If you just started joining us here, this is the Financial Strategies with Andrew and Daniel Adjemi, because people don't know what people don't know. And at Adjemi Financial Strategies, we believe that educated retiree is a happy and stress-free retiree. So we want to educate. We spend a lot of time and effort putting resources, educating people so that they can have a better perspective of how to set up their money. We have a book that we'd like to give you today before we go into our break, written by our friend Barry Dyke, and it's called Pirates of Manhattan. And Barry's written this book. He's written several books, and this book will be able to help you understand some of the things that are going on behind the scenes that maybe you're not aware of. And why would you need to know that? Well, if you don't know what you don't know, you're doomed to be able to, head into some things and receive some things that you may not want to receive. So anyway, have that book for free. The first 5 first-time callers at 800-725-7616. Pirates of Manhattan for the first 5 first-time callers, 800-725-7616. Call now.
Important financial questions. Are you feeling confident that you have enough money saved to enjoy a stress-free retirement?
Honestly, I'm not sure.
That's where Retirement Income Sources investment advisory arm comes in. We exist to help you invest your money smartly.
I'm struggling to accept my retirement without a steady paycheck. So can you help me invest into a profitable revenue plan?
Absolutely. We have top advisors nationwide who have a fiduciary obligation to you, helping you generate retirement income.
This is Financial Strategies with Andrew and Daniel Adjemi.
So, Daniel, yesterday I was talking to some people and I was giving them a second opinion on their finances. And, we'll call them Bill and Betty, right? And I was talking and we had done a stress test on their investments. And it showed that, their stress test showed that if the market went down like it did again in 2008 and financial crisis, they would lose about 32% of their money. If the market went up like it did during the bull market that we had in the mid-teens and such, they would only gain 4.8%. That's a perfect example of the risk not being worth the benefit. I'm Andrew Adjemi.
And I'm Daniel Adjemi, and you're listening to Financial Strategies. And today we're talking about passive flows or dumb money. And AAA, that's definitely not the kind of risk reward that I want. That makes
That's
me
for
puke
sure.
a little bit. Yeah.
I mean,
That's
even
a sad fact. And this is something that may be a little bit more difficult for people to understand, but it's really important. That is taking into effect the way that markets were in the great financial crisis. That's not taking into effect the way markets are today. So do people remember that Christmas Eve crash that we had in 2018?
probably not, but I remember that, but tell us about it, Daniel.
It was just like for no reason, all of a sudden in December of 2018, markets just started crashing, and they crashed something like 25%, 20 to 25%, just like in a few weeks, and no one could figure out why that was. People said maybe it's because we had hiked rates, but now we've hiked rates a lot more than that in this rate hiking cycle, and it hasn't done it. So people could not think, and markets were stronger. Things were stronger in 2018 than they are post-COVID, right? So what was it? And when we started diving into some of the financial plumbing, there was a lot of retirements going on. There was a lot of retirements going on. There was a lot of people starting to collect what's called a required minimum distribution. So if we think about money coming into markets, who has the most money, who's earning the most money, and it's more disposable. Well, I could tell you it's not 22-year-olds, it's not 25-year-olds, it's not even 35-year-olds. They're trying to buy houses, they're trying to do things. It's difficult for people in those ages, or even 40s, right?
Right.
It's difficult. They're trying to pay for kids' college education, these kinds of things. And with what inflation has been, with what asset inflation has been, with what housing is, these people, it's amazing how difficult it is for these people just to make ends meet, let alone max out a 401k.
Right.
So who was it?
So who was it?
So who is the people driving these markets up, AAA?
The older people, the mature people, the people who are in and close to retirement, when you're talking about the RMD, the required minimum distribution there, that was at that time, the age was 70 and a half. It has now gone to 73 years old if you have not yet started collecting. And for some people, it will be 75, but and you're about ready to get into telling us why that is.
So we had people retiring, right? We had high earners, baby boomers retiring. And when you retire, what do you stop doing? You stop putting money into the market, because most people's money automatically is coming out of their paycheck. And if you're close to retirement, you probably don't have many bills. You probably have paid off your mortgage. You probably have already sent your kids to college, and you have plenty of money to max out your 401k. Plus, you're trying to max out the 401k so you have more money set aside for your retirement. You're trying to top it off before you retire, right?
Right.
And then you retire and that paycheck stops. And then whether you want to or not, at some point, the money starts coming out, and that's the required minimum distribution. So what we're thinking is what's going on in 2018, why that happened, is people stopped putting money in and the flows started reversing. So now instead of money coming into these passive funds, these indexes, and driving it up, what's happening is funds are stopping and starting to come out. And then all of a sudden, these bills passed that said, let's change required minimum distribution age. Let's increase the age. And it was like, what incentive does the government have to change this age? The reason, right?
Yeah, because that means they're not going to get the money that they want as soon, right? So it's bad for the government to push the age up.
We have these huge deficits, right? It's something like $1 trillion every 100 days that the government is creating. So they need money. They need money to pay down they need money, but yet they're pushing this out. And so, I mean, it took me a while to catch on to this. Why is that happening? The government's just allowing people to keep, and I think we need to take a break here, but let's explain why the government lets us take that tax break, right? Why we have to do RMDs and dive into that a little bit.
Okay. Well, you're listening to Financial Strategies with Andrew Daniel Atchman. Today's topic is dumb money. And it's the idea that there's just so much money going into the market right now that something has to happen to it. And so it's invested in companies, not necessarily because they're valuable, but because the money's got to go someplace. And we have a paper that we put together for you today that will help you understand this a little bit better. It's called Understanding PE Ratios. You can ask for it by name. PE ratios, price to earning ratios. And we love to put this in your hand for free by calling us at 800-725-7616. 800-725-7616, because people don't know what they don't know. And how are you going to know? Unless you're told or unless you read it. So we'd love to put this in your hand. Call now for that. Today's topic on Financial Strategies with Andrew Daniel Adjmi is dumb money. So, hey, Daniel, where in the world are you today? Here I am in Madison, Connecticut. I got the world behind me thinking about it. You never know where we're going to show up, right? Where are you?
I'm out here in Boulder, or Broomfield, Colorado. Out here in Broomfield.
The Denver area. Okay, great. All right, cool. Well, glad to do that. So let's talk about this, Daniel. You said, you wanted to get into some of this stuff. So go for it, man.
So when people are putting money into 401ks, IRAs, things like that, they're saving for retirement. And the government says, you don't have to pay tax on this money. Just put it into the account. And one day you'll pay tax on it. Well, what has happened for a lot of people is it's grown and grown and grown.
Mm-hmm.
And now the money's sitting in there and they get a letter that says, you know what, you've had this money in here for so long and now you have to start taking money out. And the reason you have to take, the letter doesn't say this part, the reason you have to start taking money out is because you haven't paid tax on that. So you got this $1 million 401k or this $1 million IRA, and you need to take some money out so that you can pay taxes on it, right? Mm-hmm. It deferred and it grew tax-free. And now it's time to take probably about $40,000 out. You can take more out, but it's probably right around that $40,000 range, and taxes are paid on that. So when people retire, both of those things are happening, right? Number one is they stop putting money into the 401k. And number two is at some point, money starts having to come out. So what Vanguard and BlackRock and State Street did was they lobbied the government to change the age so that they could hold on to that money longer. Why do they want to hold on to that money longer? Well, one, it's like the game of musical chairs. They want to keep the music playing for longer, right?
Right.
The longer the music plays, the higher the artificial values stay up.
And the more money they make.
And number two, that's the more money they make. Because even if it's a 2 basis point fee or a 4 basis point fee, when you're talking about trillions and trillions of dollars, that adds up real quick.
Right. Exactly. And, it's, people oftentimes don't think about these things, especially when they're putting that money way over all those years. They don't think about taking it out, but then it comes a time. And, December is a good time of year where people, if they have not taken their RMDs, they take them out in December. And that in 2018 was a huge reason for that. People, we're retiring, but there's also a lot of people that were 70 and a half or older at that point and had to take out those RMDs. And so you're taking out a bunch of money out of the stock market and it's going to make the market drop, right? It's a supply and demand kind of thing. And so the demand was not for it. So it came out. So it dropped it.
And it's even bigger than just the normal supply and demand, because that goes back to your original story where if the markets come down, it was going to be X. If they went up, it was going to be X. But we don't have data on so much money being in the passive funds.
Mm-hmm.
And so what could end up happening is if people start retiring and they decide, you know what, I just want to take 10% of my money and move it out of these funds and put it into safer. You know what? Bonds are paying 5%, US Treasury bonds. I'm just going to take 10% and put it in that. Or they say, I'm going to take 10% and put it into cryptocurrency, or 5% and put it into cryptocurrencies. I don't know if that's going to work, but do you know what? I missed out on Amazon. I missed out on Apple. I want 5% isn't going to hurt me. And it doesn't have to be big numbers.
Right.
It doesn't have to be, you know what? I've worked hard a long time. I'm going to take half of it. It doesn't even have to be half of it. I'm going to put it in cash because stuff looks weird.
Right.
And what ends up happening is it's not dollar for dollar. This could be a gap down, because if there's not enough new money coming in to replace the money coming out, it's not based on earnings. It's not based on companies' cash flows. It's just based on X amount of dollars, that dumb algorithm.
Yeah.
I have money, therefore I must buy. And what can end up happening is they do in reverse. If people retire and stop putting money in, if people decide they're not going to invest in their 401k, if people lose their jobs and stop putting money in, right? Or if there's just not enough new people coming in. You know who else? You know who else doesn't have a 401k?
No.
Artificial intelligence. Robots don't get 401ks. So as workers also get replaced by AI, right? And by robots, jobs go away. And so this whole social investing of all this money going into passive indexes, things like that, and you're not investing your money based on earnings, cash flow, right?
Yeah.
Then you're just hoping that more money comes in. It's the game of musical chairs.
Yeah. Well, when we come back, we need to look at, passive investing is a concept of being very easy to do, right? And it's not what people used to do. And then, as you're saying, as time's gone on, this philosophy has been touted. And so now everybody's doing it. Well, everybody's going to keep doing it until they don't. And it's easy. Now, when the question that we'll leave the audience with until we come back from break is, when is it a great time to do what's easy? Well, you're listening to Financial Strategies. Andrew and Daniel Adjemi. Today's topic is dumb money. We have a book to go along with today's show that will help you understand what we're talking about more thoroughly. It's a book by Barry Dyke called Pirates of Manhattan. What went on behind the scenes with the government, what went on behind the scenes with Wall Street to create some of the financial crisis that we had, and how we can prevent it, right? Because, if you don't know history, you're doomed to repeat it. You can have that book for free by calling us at 800-725-7616. The first 5 callers at 800-725-7616 gets a book. Pirates of Manhattan. Call now.
You're locked on to Financial Strategy with Andrew and Daniel Adjemi.
About 10 years ago, my eldest grandson was 4 years old. And we're answering the question, when is it the right thing to do the easy thing? And so in my mind, the answer is never, right? Or seldom to never, right? My 4-year-old grandson, we decided we were going to make a manger for Christmas time. And so now I could have been easy. I could have gone into the woods and got the wood and that kind of thing and brought it out and worked with him to put this together. But instead I made him go into the woods. And there was a big hill. He's just this little 4-year-old guy. And there's this big long stick. I said, get that stick and bring it up the hill. And so he is bringing it up the hill, and he was moaning and groaning and puffing and huffing and and it was not easy, but he learned a lesson that day, because learning that it, doing the hard thing can be the good thing. And now 10 years later, we have the manger that we had built at that point still being used on Christmas. I'm Andrew Adjemi.
And I'm Daniel Adjemi, and you're listening to Financial Strategies. And today we're talking about dumb money or passive flows and how this is not what people think. AAA, I think that is something that everyone knows, that the easy thing is not usually the best thing. And we forget about all the time.
Mm-hmm.
People forget about all the time because there's advertising around us. Like you see somebody like, you see a Marine, or you see someone who is physically fit, right?
Mm-hmm. Right.
Not somebody that takes a lot of steroids, someone that works out, and someone who is very fit. And then you see like an advertisement on TV where you could buy this thing, and it, you put it on your body and it will make your muscles strong and look good, right? And you're like, there's a disconnect. The person who has this amazing, physique worked very hard for that. They spent hours and years and everything building that. They ate the right foods. They did all this. And the person that's watching TV and they put this thing on their belly to get rid of it, like it's never going to be the same, right? Right. So we know that that's true, but somehow we forget, or we don't want to go through the hard thing, pulling the stick up the hill, right? Mm-hmm. Right. But then we look back 5 years later and say, look at this thing that lasted for so long, this major that lasted so long. Or we say, look at these muscles that I have accumulated by pulling the sticks up the hill, or whatever it may be, right? And those difficult things pay off not just a little bit.
Yeah.
But they pay off in multiples, right?
Right. Exactly. But, that's the point. What parent ever teaches their kid to do the easy thing and to take the easy way out? I mean, there are some parents that do that, unfortunately, but I guess I should say, what good parent, usually you teach your kids to do the hard thing, because, that's what brings the greater value, like you were saying, in the regard to the wonderful physique. It takes work to be able to do that. But what's happening when it comes to investing, they're trying to make it easy on people, easy on firms, easy on the people, right? That's why they came out with these target dated mutual funds. Oh, when are you going to retire? Oh, 2035. Okay, so go into the 2035 plan. There, you don't have to think about it. Just all you have to think about is when you're going to retire, and that's the one you invested. Well, guess what? The fees on those things tend to be higher than other ones that if you did some research that you can do. But that's the problem. There's no research, right? And not only are the fees higher, but the returns are lower than the things that are the harder way to go. So what do you want to do, right? I'm always saying about how, the firms out there that, people think, oh, this firm is managing my money for me. And, it all in, they're charging 2%. And for some reason or another, they think that that's a good value. But when I point out to them that, all they're really doing is checking a box, they're not managing their money. They're checking a box. They're doing the easy thing. And then, the people who are actually, maybe if anybody's managing the money, the mutual fund and, managers, well, they're making less money percentage wise than the people who are, the faces that they're managing their money, quote unquote. So, the easy thing tends to cost money.
Yeah, it causes pain in the long run. The difficulty is you don't see it right away. Just like if you decided to eat a healthy meal, or you decided to just, get something that tastes really good that's terrible for your body. And one day, in 2 days, it's not going to make a difference. But if you continue to do that, the compounding effect in 1 year, 5 years, 10 years, the person who made the sacrifice and ate the good thing compared to the person who just ate the thing that was convenient and tasty, or not that good food can't be tasty, but the thing that's just there, it's not going to be even close. Like they're not going to look similar. One is going to look completely different than the other person, right?
Right.
And so just because it's worked for the last decade does not mean in the next decade or 30 years of retirement that will continue to work. In fact, most likely there's going to be some catastrophic problems. And that's why we're bringing this to people's attention so they can start making decisions on purpose ahead of time. Then being this person who ate the terrible food and who's spending their whole life in the hospital because they have heart disease and they're obese and these kinds of things, compared to the person who's going and spending their retirement on cruises and with people they love because they were eating the proper foods.
Yeah, very good point. Very good point. And as we're looking at this stuff, what's happening with investing in the market and with investing in general, right? 401ks and IRAs and just all these different things that we're talking about today, this dumb money stuff, it creates a false sense of security for people. And, it is, recently, my friends were telling me about a video they saw of a mouse, going after some cheese in a mouse trap. And he goes and he gets some of that cheese and he runs back and he eats it. He likes it. He goes back for some more, right? But the third time he goes back and bam, he gets his head cut off, right? And it's like it's what they do with the Ponzi schemes, right? And they let people experience success a little bit, and then bam, they're caught in the mousetrap. And that's what the false sense of security brings. And it happens with people's retirement plans. And that's how people run out of money, or they don't get to do what they want to do in retirement because they do what everybody else is doing until they don't. You're listening to Financial Strategies with Andrew and Danielle Edgeman. Today's topic is dumb money. We have a paper that we'd like to give you today that goes along with today's show, and it's called Bonds versus Bond Funds. And the whole premise of this is there's a big difference that people usually don't understand between bonds and bond funds. I mean, that, bonds are safe compared to stock, which is a true statement if you're talking about individual bonds. But most people, when they talk about investing in bonds, they're investing in bond funds. Why? Because bond funds are easy. Not necessarily good, but easy. At the top of the show, we talked about somebody that had the possibility of losing 32%, but it only increasing about 4.8% because they're invested in bond funds. Bond funds are not going to go up the way stock funds will. So the question is bonds versus bond funds. Understand how to use them, where they fit in, if they fit in. You can have that paper for free by calling us at 800-725-7616, 800-725-7616, or catch us on the web at agemy.com. The two words AGEMY, spell our last name of Agemy, AGEMY.com. Check us out now. You listen to Financial Strategies. Today's topic is dumb money. Daniel, people, what comes to my mind when we're talking about this dumb money, right? And talk about how the old school way of investing, that kind of thing. It's really interesting. If we look back into, prior to 1974, 1975, most people's retirement plans were based upon pensions that the company would have and maybe Social Security. And then 1974, pensions started to go away in a big time way from companies. To today, it's very hard to find a company that you can get a pension with. And 401ks came into play. Well, about that same time, what was happening? Well, baby boomers started entering the workforce. Now, baby boomers, so we got the biggest generation of ever before at that point, and they're starting to make money, right? And by the year 1984, basically the last or thereabouts, the last baby boomer enters the workforce. And so there's more money than ever going into 401ks, and they have to put the money in the stock market. So it's driving up the market. What else is driving up the market? Well, baby boomers, they're having kids, they're getting married, they're buying houses, they're buying cars, they're spending money. And so that's driving up the market, right? Because widgets are being bought and sold and manufactured and all that stuff. And it's all driving up the market. And the 80s and 90s, the best two decades in stock market history. And then, 2000 comes and the market drops big time. And ever since then, it's been doing these different things. Sure, the market's been going up, but now, right at this moment, the stock market is going up, but it's not based upon the fundamentals that were happening in the 80s and 90s, like with the baby boomers. Today, the baby boomers is still the biggest generation, but now they're closer to, like we talked about, taking out their RMDs, they're retiring, they're not putting as much money into the stock market. As a matter of fact, they might be taking more money out of the market than what they're putting in at this point, right? And they're not buying houses. They're staying in their house. They may be remodeling their house, but that's the extent of it. And the younger generations are not doing as much because there's not as many of them to start with, and they're not doing as much as buying houses. They're renting. They're not buying cars as much, right? They're not doing some of this. Some of them are, but not as a whole. like that, right? And what I'm interested in before we got a couple minutes left before we have to go to break, Daniel, but you were talking about the next generations. You're part of that next generation. I'm a baby boomer. You're the next generation, right? And you see things being different coming with the next guys, right? To where, they're not putting as much into the market and they may be investing in a different fashion. Talk to us about that.
Well, there's a lot of things to cover with that, but you had mentioned a few things. Like you had mentioned these target date funds, for example. You mentioned baby boomers retiring. You mentioned flows coming out because people want to spend money or people have to take it out for RMDs. So all of these things are reverse flows. The target date fund is taking money out of stocks as you get closer to retirement, and it's putting it into bonds, which we haven't even talked about how these bond indices are very bad for investors.
Right.
But so all these things are driving it down. So if more flows are coming out of these passive flows, out of these indexes, than going in, what will happen? Like, you don't have to be a financial mind to think about this. Just think about it with anything. Think about if water is flowing into a bathtub, the bathtub water level will continue to rise.
Right.
Until it stops. Now, if more water is coming out of the bathtub than going into the bathtub, what's going to happen? The level will go down. And because these flows are not based on fundamentals, like you were talking about, because people are buying things and it's driving, companies are being more profitable. Because no one's doing the work. There are companies that are becoming more profitable. There's a lot of good opportunities out here. The difficulty is it's the dumb money. It's a stupid algorithm that says, I have money, therefore I must buy. And it's going to work in the reverse, just like the bathtub. Once more money's coming out than coming in. So what would drive more money into the market? Well, if people had to work longer, if baby boomers had to work longer, that would drive more money in. If we increased the amount you could put into your 401ks, that could increase. Yeah, that's happened, hasn't it? Yes, that continues to happen.
Correct. Every year, yeah.
If the younger generations decide that they want to put a lot more, or they're able to put a lot more money in, or they get inheritances and decide to do that. But what happens if they don't? What if they think that the current system is disenfranchising them? What if they decide they're going to do it different? What if they decide that the way their grandparents invested or their parents invested in indexes and with Morgan Stanley and with UBS and with these kind of companies, what if they decide that's not the way they want to do it? They want to be a little bit more aggressive. They want to invest in something different. Then what happens to the bathtub? What happens to the water coming into the bathtub?
Right.
Maybe it starts going the other way.
Exactly. Starts going down the drain, maybe, huh? And getting lesser. And that's a point, right? The next generation may decide to invest in Bitcoin or digital currencies or other types of things, if at all, right? And Bitcoin and digital currencies are not the stock market. And so that's going to affect things from that angle. So there's a lot of different things. And, like we said, 3 things in life are certain: death, taxes, and change. And the question is, you got to change with the times. You can't do things the way that you always did things. There's fundamentals we can learn from old school and from the past, and there's history that we can learn to keep us from making the same mistakes going into the future. But the question is, what is going to happen and how to prepare yourself, how to create a portfolio, a proactive portfolio that's defensive, diversified, thoughtful, active, robust, that will help you to be able to retire, stay retired, and never run out of money. That's the key, right? That people don't think about that because, anyway, I'm getting off. Anyway, you're listening to Financial Strategies with Andrew and Daniel Adjemi. Today's topic is dumb money. And we are going to have to take a break here. It's pretty exciting topics, but we have a book we'd like to give you. It's called Pirates of Manhattan by our friend Barry Dyke. And Barry has done a great job of writing this book, that if you're interested in learning more about what's going on behind the scenes and everything, this book is up your alley. You can have it for free for the first 5 first-time callers at 800-725-7616. 800-725-7616. Call now.
Time for some tough questions for these financial advisors. What makes retirement income source different from other financial?
Our extensive experience generating investment income quickly so you can have financial peace of mind, navigate your retirement smoothly, and have more time to spend with family and doing the things you love.
We gotta talk to these guys. We're done here.
This is Financial Strategies with Andrew and Daniel Adjemi.
So I wanted to tell you about a little story here. The story is, Daniel went to Columbia in New York and to get his certified portfolio management degree. And he's walking down he went to lunch one day with a professor, and, they go outside and they see $100 bill laying on the ground. And the professor, and Daniel says, "You see that $100 bill?" To the professor. Professor says, "No, there's no $100 bill there. I mean, if there's a $100 bill there, somebody else would have picked it up by now." That's what I'm trying to teach in class, Daniel. And Daniel reaches down, picks up the $100 bill. They go to lunch. And so they're enjoying lunch, and the bill comes to the table, and the professor says when it comes, he says, Hey, Daniel, you're going to pay for lunch with that $100 bill?" And Daniel says, "What $100 bill?" I'm Andrew Adjemi.
And I'm Daniel Adjemi. And you're listening to Financial Strategies. Today, we are talking about dumb money. And AAA, these passive flows we've been talking about really have disrupted a lot of different things. And that story you told is basically what we talk when we talk about an efficient market hypothesis, right?
Right.
And basically what professors have been teaching, and people will still argue to this day, which I can't understand, is that markets know everything. So there's no good deals in the market.
Right.
You just need to buy the markets because there's no markets know everything. So that you couldn't possibly know something more than the market and take advantage of it. And just like that story indicates, there's plenty of people picking up $100 bills, but they're not going to admit they're picking up the $100 bills, right?
Right.
And that's why this can continue on. So at one point in time, passive was outperforming actively managed managers. And the actively managed investors were charging too much money for actively managing. So more and more money went to passive. And then BlackRock, Vanguard, State Street started saying, this is pretty cool. And they went from just being passive managers to being advertising arms and lobbies for the government so that more money would come into that. And now we can see that there's plenty of active people who are outperforming markets. There's $100 bills laying in the streets.
Right. Right. People are finding good deals.
The algorithm does not look, the dumbest algorithm ever created does not look for those $100 bills. Right. Again, people might be getting tired of me saying this, but this is literally how it works. And it's frustrating to see people putting their good money into this stupid algorithm.
Right.
I have money, therefore I must buy. It doesn't matter what the price is. It doesn't matter if I think things are expensive and I want to hold some money to the side to buy later. It doesn't matter. I have to buy. And the higher things get, the more money goes into those things.
Right. Right. True management is not going on today, folks. Research, people are not doing research generally as much as they had in the past. Most people are investing in things that are not being researched.
There's no research.
Right.
No, right. There's no one researching. No one.
Right. 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 And that's what I said earlier is, because these people, all around us are thinking, oh, these people manage my money. And they don't. All they do is check a box. How hard is it to check a box? Right. And it's easy. It's the disease of ease will kill somebody and kill somebody's portfolio. How many advisors does it take to ruin somebody's portfolio? One. Whether that's yourself because you're doing it yourself, or it's somebody that you're hired to do it and you're paying them. And that's the egregious thing. You're paying them to ruin your portfolio. So you need to be able to have smart money. You need to be able to find those $100 bills on the ground, those deals that are out there. How to be able to buy a $10,000 investment for $8,000. That's going to pay you 5 or 6% interest or 7% interest or whatever the case may be, right? That's what you need to be able to find.
With mathematical certainty.
Right.
Instead of hoping more money comes in and keeping the bathtub full, right?
Right.
Or rising the level of the water in the bathtub. there's a mathematical certainty to your return and to getting your principal back.
Right. Most people don't pick stocks anymore. Most professional financial people don't pick stocks anymore. Most individuals don't pick stocks anymore. They pick mutual funds, or they pick an index, or whatever the case may be. And that's what you have to be aware of if you want your money to last the rest of your life. You need to have a smart portfolio, defensive portfolio, diversified, thoughtful, active, robust, something that will work no matter what. And not just the investments inside the portfolio, but like Daniel, in one of our recent shows, Daniel was talking about the 3 pillars of the different types of investments, being some guaranteed liquid money, being some, the income producing money, being some guaranteed check, right? Because when it comes to retirement, hope is not a retirement plan. And if you hope that you're going to retire, or hope to have enough money, it's one thing for a 20-year-old, 30-year-old, 40-year-old to hope. That's okay. But for a 50, 60, 70, 80-year-old to hope, we're going down the wrong path. You're listening to Financial Strategy with Daniel Adjemi. Today's topic is dumb money. We have a paper that we'd love to put in your hand to be able to help you understand, educate yourself to be able to make smart decisions, called Bonds versus Bond Funds. And many times people don't understand the difference. They think they just say bonds, and that could be individual bonds or that could be bond funds, but they're totally different. Bond funds were meant to be easy, the disease of ease, where individual bonds take more work, but are typically more profitable and safer, generally speaking. So we love to put this in your hand to help you be able to understand this for yourself. And you can have that by calling 800-725-7616, 800-725-7616, because people don't know what people don't know. At Adjemi Financial Strategies, we believe that a educated retiree is a happy and stress-free retiree. We want you to be educated. Daniel, as we're talking about this and this dumb money today, what else? We just have a few minutes left in the show for the rest of the day. And seems like there's still so much more to talk about, right? In my, we talked about where, is the risk versus the reward, right? The risk of, maybe the stock market may be averaging, the S&P, the indices maybe average 7 to 9% over time, but what risk are you putting forth? And from our perspective, certainly the risk there is not worth that kind of reward. The risk that you're putting forth should be putting forth more of a 20% return, yet the markets are not creating a 20% return on average from that. But there's just so many things. How can we finish up today to be able to wrap this up in a nice package for our listeners?
Well, you just gave out that paper on the bond funds. And one thing with bond indexes, people will buy bonds, people will buy bonds or buy bond indexes, bond funds, bond indexes, because they think that that's safe. And a bond fund is basically just an equity in a company that owns bonds, right? But it can be even worse than that when you're talking about a bond index, because a lot of these bond indexes are also market cap weighted. And so let's say you have an XYZ bond. An XYZ bond is $1,000, right? It's $1,000 par. So there's 100 million bonds in there. And that drives up. So when the country, the government, the company buys it back from you, they're going to give you $100 million. Well, it goes above par. And now it's 105 million. And now it's 110 million. And now it's 120 million. And what has to happen is the dumb money coming into the fund has to buy more and more of this bond that's worth 125 million when you know that they're going to buy it back from you at 100 million. Does that sound like a good investment? And you say, well, why does that happen? How could that happen? Because there is no one doing the research. It's an index. It's an algorithm that says, I have money I have to buy. So it's even worse with some of these bond indexes. So you have to be so careful when you're buying bond funds. The other thing so the reverse of that and the $100 bill that's lying on the ground is we see, now we're not talking 100 millions because we're talking about small investors now. That's a fund, right? Or it could be 120 billion. But you, with your $10,000, we see a good solid company that is generating tons of cash flow,
Mm-hmm.
and they have more money on their balance sheet than they owe in debt. And this is trading at $8,000 for 10 bonds. So you know you're going to collect whatever the coupon is paying you plus $2,000, 20% of appreciation. And you say, well, how could that be? And I'll tell you how that could be. Because if that's one notch under investment grade, it has to be sold out of all these bond funds. And it's just sitting there. Why is it one notch under investment grade? Well, maybe the rating companies just haven't rated it in a while. And the actual fundamentals of the company, it used to be a junk company, but something changed and they've got all this cash. They've got more cash than debt. And they have robust cash flows, but they haven't got upgraded yet. Wouldn't you want to know about that? Wouldn't you want to buy that bond? And so we see a lot of these things. We're seeing a lot of different types of investments where it's not in the index, or it's international, or it's a bond that had to be sold out of a bond fund or hasn't been put into the funds yet. And when you're able to do the due diligence on the individual companies, you can build a portfolio that's not reliant on flows coming into the stocks. It's actually backed up by a solid balance sheet company. It's backed up by cash flow. It's backed up by earnings. And then you don't have to worry about if things change or when things change, because I don't think it's an if. Younger investors are not going to invest the same way their parents and their grandparents did.
Right.
Because we can look at history and see that happens. Things work until they don't, right? So passive flows have worked. And we know that at some point, people are going to realize the scam that it is, and they're going to change. And if you're the person left without the chair, it's going to hurt you. And so we're talking especially to people who've already built up their wealth. We're talking to people who are close to retirement. And Andrew, you said at the beginning, people need to be looking at this, even if the passive wasn't a scam, even if this whole philosophy of passive and indexing and investing wasn't manipulated the way it has been, people who are in retirement already need to be thinking about making a change. So what not a better time than now, when it's really getting to a spot where these fund managers like BlackRock, State Street, and Vanguard are actually manipulating and controlling markets. Is that where you want your money, where that a fund manager can control that? Or do you want your money to be backed up by a solid company or a solid government that has cash flows to pay you, right? And someone did the work. Either you did the work or you hired someone who knows how to do the work to know that this is a company that's valuable, right? That's undervalued.
Right.
That's what we're looking for. Those $100 bills on the ground, something that's undervalued. And there's a lot of opportunities because there's not as many people doing the work. Then I would guess, at least in the last couple 100 years, if not of all time, but definitely in the last few 100 years.
All right. Well, the analogy that comes to my mind when you're talking about that is, all your life, you're going up the mountain of retirement in a 2-seater sports car. It's fun. It's sexy. It's really great. And you're just moving along in these indices and this dumb money investments and whatever the case may be. And then you get to the top of the snow-capped covered mountain and you retire. And do you really want to go across a snow-capped covered mountain in a 2-seater sports car? Or would you rather have an all-wheel drive SUV driven by a professional driver that's been there before? The choice is yours. And that's what we're talking about here. Having smart money, having smart investments to be able to have a robust, a proactive portfolio that's going to weather the storms of life, weather the storms of retirement, so that you don't run out, so that you can retire and stay retired. You've been listening to Financial Strategies. Andrew Daniel Adjemi. Today's topic's been dumb money. We have a book that we want to give you before we go off the air today. It's called Pirates of Manhattan by Barry Dyke. It's a great book that I think you'll enjoy, be able to educate you further so that you can be able to understand what you don't know, so that you can have stress-free retirement. We'd love to put this in your hand by calling 800-725-7616, 800-725-7616 for the next 5 first-time callers. Get your copy of Pirates of Manhattan. Call now, and we will look forward to coming back to you again, because people don't know what people don't know. We believe that an educated retiree is a happy and stress-free retiree. Join us next time.